What truly drives defense stocks? Is it just global conflict, or are there deeper, more stable forces at play? Let's break it down. Part 1. What are defense stocks? Defense stocks are shares of companies that build military and national security systems. This ecosystem includes hardware like fighter jets and naval ships, the software that powers them, and critical infrastructure like radar and satellites. Their primary customer is the government, leading to massive long-term contracts that provide a predictable stream of revenue. Part 2. What moves them? It's a common misconception that these stocks only thrive during active wars. While prices often see a short-term pop from conflict headlines, the real driver is the government's reaction. Rising geopolitical tensions often push lawmakers to increase national defense budgets, which translates directly into larger contracts for defense firms. For this reason, many investors view these stocks as a hedge against global instability. But peacetime still pays consistently. The bulk of revenue comes from deterrence and modernization. Nations must continuously upgrade aging fleets and invest in next-generation technology to maintain a strategic edge. This multi-year procurement process provides a steady, non-conflict-driven demand that forms the financial bedrock of the industry. Part 3. Who are the players? The industry is dominated by a handful of giants known as prime contractors, like Lockheed Martin and RTX, who manage the largest projects. But beneath them is a deep network of Tier 2 and Tier 3 suppliers, providing critical components. Beyond traditional hardware, specialized tech players focused on areas like AI and data analytics are also becoming central to modern defense. Part 4. How to frame it. So, how should you analyze these companies? First, look at the backlog, the total value of contracts won but not yet fulfilled. A key related metric is the book-to-bill ratio. A ratio over 1 means the company is winning new contracts faster than it's completing old ones, a healthy sign of growth. But fundamentals always matter. Focus on core financial health. How efficiently does it generate cash? That's free cash flow conversion. How well does it deploy capital? That's return on invested capital. And assess its valuation using multiples like price to earnings to ensure you're not buying at a cyclical peak. If picking individual winners seems daunting, you can opt for a diversified approach through exchange-traded funds or ETFs like ITA or XR. These hold a broad basket of defense stocks, giving you exposure to the entire sector. In short, defense stocks are built on stable, long-term government contracts, driven by national budget priorities and the global demand for security. Whether analyzing single stocks or using an ETF, the key is to understand the unique drivers of this complex sector.